Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates with your agriculture update for this Wednesday. And this is the 14th of November, 2018, just before 3:30 p.m. Central Daylight Time. Another one of these mixed days. Today you got the beans up, the wheat down 4 3/4. Again, corn very close to unchanged. We're just back and forth with that. The dollar was down today against most of the major currencies, which also supports a little bit of the grain complex. But the stock market's let go, and the rally in the energies just looks like a dead cat bounce. In other words, you get a little bit of a lift, but it really doesn't have legs to it. And my fear is that market, if it goes down again, pulls the stocks even lower tomorrow. So it's just something you have to think about. In the soybean market, the market has stayed over the 18-week moving average of closes. When that occurs, I view the market as having a bullish bias. Close under that number, I have a bearish bias. It's one of many things that you look at when you're looking for trends. When we take a look at this market visually, it's pretty easy to see that the market's got a peak and it's got a spike bottom. Right? I think you'd agree with both of those. And the market is being caught in between there, waiting to see which way this market wants to come out of that. For the moment, with today's low, you took out a previous break low, so now you have a higher high, lower low, which means the way I define a trend, there is no trend. What you have going as a chartist is, in an uptrend, you have higher highs, higher lows, or lower highs, lower lows. That's a downtrend, and then the first one was the uptrend. No trend is this with a higher high and a lower low. The market is likely going to, if it drops any further, test the 100-day and the 18-day average of closes. If it doesn't, then it's got to get over 890 3/4 to put in place the pattern of at least making higher highs again. When we take a look at Bollinger Bands, the importance of them is initially when attacked, they offer resistance and support because the algorithm is based on the fact that the market will trade within these bands 95% of the time. You can see when it got up here, it didn't go very far there, and when it came down, it didn't go very far to the downside. Doesn't mean you can't go lower, but it didn't hit the band again, and that's the important part. When you look at momentum, the slow stochastics, which I use as a momentum oscillator, is going flat. Now, other traders use relative strength, MACD. I use the Arun index, and I will be doing my videos on those. In fact, I've recorded how to apply it on your chart already and how to interpret it, and now I'm just doing the PowerPoint for you that explains the formula, but after that it'll be out. So let's talk sometime next week. You'll get that indicator. These are all methods of measuring momentum. They're not forward-looking, they're current or back-looking as a group. When you look at December soybean meal, the market, like beans, has a higher high, lower low component to it. It is oversold. The market is challenged. Now, if you take a look, it is challenged in succession a number of times, the 18-day average, and each time it has failed against it. While that has gone on, you're narrowing these bands. We want those bands to narrow and eventually go sideways, and from there we build. It's like a spring in a pipe. You start building, if you will, the compression for whatever the next move is going to be. December soybean oil, the market still has, by the way, the embedded reading. I still say this market, until it loses that on hard rallies, the market will probably meet sellers. Lose that reading, get the red line over 20, and at that point, I think the market can make a run for the 18-day average. But at this point, the trend is down, lower highs, lower lows. The bias is down, and momentum is locked in bearish. In the corn market, you have nothing really. You got a higher high, lower low pattern here, trading against and between the 18-day average in red and in green, the 100-day average of close. Momentum is dropping off. Prices are dropping off. If prices continue to drop and get through 365.5, you'd have a pattern of then lower highs, lower lows, putting into play 361 3/4. take a lot to break it out of that, but it could happen, but we'll see if it does. In the wheat market, the first challenge, don't be surprised again, of that Bollinger Band, that's how I started you off talking about it, got to that. The market immediately pulled back to the 18-day average, and it's following through to the downside. Is the market trading? Well, if you look at the market and we go back to the lows, we have a period where this low took out that one, and then we have a higher high. So I define it as no trend. Today's close at 503 is slightly underneath the 18-day average, so the bias is down and momentum has been pointing down. In the sugar market, whenever you have a locked-in bearish embedded slow stochastic where the numbers are going sideways under 20, until that's lost, and if you go and you do your energy charts and so on, you will see how this both to the upside and the natural gas, not as much a play there, but the downside in heating oil, gasoline, the crudes, they all worked in with that. Lower highs, lower lows, still in the bear camp. Until it loses that reading, I think the bears still have total control of that market. In the coffee, you found support against the combination of the 100-day average in green, the lower Bollinger Band. You're getting a bounce, and the market is just plain oversold. In the cocoa market, as we said, if you took out yesterday's low, and that was right here we were talking in that tape, you might make a run for the lower Bollinger Band. Now that you're oversold already that much, you know, you don't have to go to exactly that number, but in chartist terms, which I am, it's following through with its progression of downside momentum in the market. Look at this vertical decline. It's gone from 23.96, it doesn't look like it, but down to 21.36. That's 260 points. That's a big move in cocoa. That's not small. In cotton, upper Bollinger Band hit, lower Bollinger Band bounce. So you stop there. So far for the moment, you've stopped against the lower band, not trending. You got higher highs, lower lows, and you're oversold in the market. In the cattle market, battleground is pretty clear to me. It's the 100-day average of closes with support at the lower Bollinger Band. You're oversold. You got a higher high, lower low pattern. I don't see what to do there. Feeder cattle ended a bear run today. It ended it because of several things. Number one, you got over the last rally high, this one. The market was a few days trying to stay under that Bollinger Band, couldn't do it, and a big lift to the upside, and momentum has shifted in the market. If we take a look right here, both numbers were under 20, both numbers under 20, and both under 20. When you lose an embedded reading, and an embedded reading requires a minimum of 3 days under that, prices often make a run towards the 18-day average of closes or the closest of the key averages, the 100 or that one. There's even another one. I don't show you all the key averages here, but that's what I think the market's doing. And in the hog market, the battleground's the 18-day average. The trend is up. You got the higher lows, higher highs. The back end of the hogs look a little more bullish than the front end at this point. You've lost your upside momentum. It's just flat, but the bias is still up. Unless you take out 55.60, I still think the bulls are trying to defend their 18-day average position at 56.75, but I think if you get under 55.60, you step out of a trend again and just are in no man's land. I want to remind you that I do an awful lot of research for my clientele, and I'd like you to see what I write about. It's in the grains, it's in the energies, it'll be in the currencies, it's a little bit of everything. And of course, you can always then sign up for our Linn research. So if you're a grain or a meat trader, it's very specific. Options, the futures, derivatives, if you're a cash user, what it is, if you're a producer, how to do hedging, it's all there. I'm not talking brochures, I'm talking exact ideas. Give us a call. You can go to our website, and you can always sign up by clicking right here. I'm Ira Epstein. You have a great day.